there's obviously the Fed backstop with the prospect of rate cuts starting in July. And then, of course, you have hopes that the Trump and Xi meeting at the end of the month will be productive and lead to talks that would at least stave off new tariffs and hopefully remove some of the existing ones.
I don't want to suggest that our conflict with Iran will grow. Let's hope that it does not. However, I understand your point about the Federal Reserve, Peter, but when you are facing at least the theoretical concept of a military conflict with Iran, I'm not going to use the W word if you know what I mean, is the Fed powerful enough to overcome that?
They're not, but I think the market always assumes that these geopolitical hotspots always cool down and that we never get to the point where it's the fearful situation that you never want to see. So I think that that's the mentality. And geopolitical situations mostly don't lead to something. You get to a certain point and things always back off. And I think there's the assumption that there's going to be the case here is that cooler heads will prevail. And even with this jump in oil prices, you're still at the lower end of this multi-year trading range.
What if Trump and Xi do not get to some kind of a deal at the G20?
That would certainly be a negative. And the Feds would try to offset that by a cut, but I don't think that's going to matter.
Well, but the market already expects a cut. Steve Leisman told us yesterday there's a 100% chance of a cut in July. By the way,
yes.
I hate when anybody says 100%.
Right.
But that's what the market expects.
Right. That's the 100% priced in as of today. That obviously can change tomorrow because if there is a deal, then those rate cut odds would get pulled back. So manufacturing has slowed. The global economy in terms of manufacturing is in a minor contraction. If you look at the PMI numbers, we'll get some more today. So if there's no deal, then that gets exaggerated and you'll see further declines in manufacturing activity that could threaten and spill over into services.
Okay, outside of that, we had our number of the day yesterday. You know what that number of the day was yesterday? I won't hold it if you didn't see it.
I do not.
12.5 trillion. You know what that is?
Yes, the negative yielding securities.
Correct. The amount of debt around the world
right.
that has a negative yield. Japan, Germany, Switzerland, Sweden, Denmark. I think there's another one that's thrown in there.
And to put that into context, it's like 20 to 25% of the entire global bond market.
Correct. How does that end? Not next month. Maybe not next quarter, 2 to 3 years from now. How's that going to play out?
Well, it's playing out in terms of the profitability of European and Japanese banks. Over the last 30 years, the Japanese bank stock index in nominal terms is down 90%. When the ECB went to negative interest rates in June 2014, the European bank stock index is down 40%. It's playing out in real time. And the longer this continues, the worse it's going to be for these banks. And I'm worried that the Fed is going to start repeating the mistakes of those central banks, lowering interest rates to the point where U.S. banks have difficulty making money, and that becomes a crimp on U.S. growth.
Okay. I don't want to scare anybody. It's a Friday. Okay. 12.5 trillion in negative yielding debt. 242 billion, according to Moody's, in oil and energy-related debt around the world, much of it coming due in the next 5 years. The consumer in the United States is now, on many metrics, more indebted than they were just before the financial crisis.
Right.
The world is laden with debt. Can we get through it this time?
Well, that's why the Fed is pushing on a string by trying to lower the cost of money because we already have
Doesn't that
so much
encourage
debt.
people to borrow when already our cup overfloweth?
Exactly. That's why relying on the Fed to save us I think is misplaced because they're pushing on a string is going to be a term that we're going to hear more and more of. It's obviously clear in Japan.
Yeah.
It's obviously clear in Europe. And it's unfortunately going to be obvious here, I believe.
We got to go, but quickly, when do you think the stock market starts to care? Because it has not.
I think when we start to see second quarter earnings and we can see the corporate impact of this global slowdown, particularly from the multinational perspective, that's when they'll begin to care.